This Canadian stock just reported earnings and it is absolutely crumbling. It's crashed 9.9% on the day and it's down nearly 40% from its all-time high about a year ago. So in this video, I'm going to be going through the earnings results to give you a better understanding of why this happened. Then I'm going to check to see if this stock is presenting a good buying opportunity at this lower price point. Cutting right to the chase, the company whose share price has been sliced and diced is MTY Food Group. MTY is a Canadian headquartered restaurant company that owns and franchises out over 90 different restaurant brands, including Cold Stone Creamery and Wetzel's Pretzels. And the one-day drop post-earnings slashed over $100 million from the company's market cap. Taking a look at the cause, well, the company saw declines to the top-line revenue growth of about 3% this quarter, as well as a 5% decline to the bottom-line earnings per share. Diving a little deeper into the revenues, we were told that the company was negatively impacted by extreme cold weather events that took place in January and early February, which really hurt system sales for frozen treats, and that makes up a significant percentage of the company's restaurants. Also, there were unusually extreme snowstorms that occurred within Quebec and Northern Ontario that severely hampered sales temporarily in the affected areas. Add on top of that the continued mild weakening of consumer spending, California raising its minimum wage, and another quarter wherein the company had a net loss of 4 locations, and there you have all the necessary ingredients to achieve this quarter's poor results. But that still isn't the end of the bad news. The company will also have to deal with additional headwinds in the coming quarters as Quebec just raised its minimum wage at the start of Q2 and Ontario is set to do the same in Q4. Plus, on the conference call, we learned that the new enterprise resource planning system will probably take another year and a half until it's been completely implemented into the network, and that the company doesn't expect to start seeing any efficiencies from the ERP system until it's been fully implemented. So yeah, that's definitely not good to see, but at least some of the bad news was lightened by some of the mitigating information that we were presented with on the conference call. First, the extreme weather events were a pretty freak one-time occurrence that are highly unlikely to impact sales in future quarters. Also, when it came to EPS, a large reason why that came in lower than expected had to do with impairments to corporate locations, which don't actually affect the amount of cash coming in or going out of the business, despite it being considered part of the net income. So the company wasn't actually less profitable on a free cash flow basis, as you'll see shortly. But first, going back to the net store closures, it's always been noted that Q1 is exceptionally difficult to achieve net store openings, since so many of the franchising contracts expire at the end of Q4 and require re-signing. So naturally, Q1 tends to have the most total store closures, which of course makes it harder to achieve net openings. So not all of the bad news was so bad, and some of the news was even pretty good. For example, their traditional free cash flow and free cash flow per share metrics hit an all-time high. But this was a bit disguised by the company's decision to report the metric in a different way than it had in the past. That being free cash flow per share net of lease payments. And while lease payments are a legitimate recurring cost that should have been factored in to begin with, the company didn't used to do this, and they were under no obligation to make this change. And in doing so, it made what would have been the company's best free cash flow quarter ever look a lot less impressive. This is because the company's previous record of free cash flows net of lease payments came in August of 2022, the quarter before the company completed its acquisition of Barbecue Holdings, wherein it took on hundreds of new corporate store locations, which came along with corresponding lease payments. But even with this change, this was still a fairly strong quarter for the company in terms of profitability. And this profitability allowed the company to pay down $34.6 million of debt while repurchasing $3.6 million worth of shares at a cost basis of slightly over $50.50 per share. And all of that was in addition to paying out the recently raised quarterly dividend of 28 cents per share. Now, there is still a lot of debt on the balance sheet, but things are considerably better than they were last quarter. and MTY's regular quarterly debt payments have rapidly cut down on the amount of quarterly interest expense that is owed. Also, according to the CEO, the pipeline of new locations that are lined up to be opening in the coming quarters is still very strong. So, for the most part, that was all of the good and the bad news that came out this quarter. But there are still a few extra pieces of information that kind of fall in between, or might just be explanatory, but are still worth covering. So I'm going to quickly go through all of that, and then we'll get into the price, and I'll be telling you if I'm going to be buying, selling, or just holding my shares. Alright, so last quarter we were hit with the bad news that because of the cutback on government funding for the EBT program in the US, Papa Murphy's underperformed. Well, this quarter we were filled in a bit more on the extent of the impact that the government cuts had on sales for the take and bake pizza restaurant. According to MTY's management, EBT-related sales at the Papa Murphy's brand had made up about 14.7% of sales in the prior year compared to 8.75% in 2023. So we're looking at a decline of about 6%, which isn't great considering that this is MTY's second largest banner. But excluding the EBT-related declines, the banner's sales remained fairly flat, which indicates that this decline probably isn't indicative of a recurring trend. In other news, we were also informed that the company is not looking to make any significant acquisitions this year, and that the focus continues to be on improving the current brand network. Finally, and the biggest surprise to me, was learning about the creditor's cap on capital allowed to be returned to shareholders. Apparently, since 2016, MTY has had a credit agreement to not return more than $50 million per year to shareholders in the form of dividends or share repurchases. And in return for this stipulation, the company has received favorable terms regarding the interest rates owed on debt. Personally, I didn't realize that this was something that was in place for the company, but looking back, it makes sense as to why in past quarters the company had chosen not to repurchase shares or to only repurchase seemingly minimal amounts at what seemed to be very low prices during time periods where the company had a relatively substantial amount of cash on hand. In the Q&A session, the CEO was asked about possibly removing this cap, but he was seemingly uninterested in this since removing the cap would mean renegotiating interest rates on the debt pile, and considering the fairly low interest rates on the debt, this probably would not be beneficial for shareholders at this time. And that was MTY's quarter. So, is the company a worthwhile investment at about $47 per share? Well, the company is still set to experience some short-term headwinds, like the upcoming minimum wage hikes, on top of other ongoing challenges like the seemingly insurmountable number of store closures, the retail product sales having seemingly hit a brick wall, and a somewhat weakening economy. On the other hand, the company is raking in serious amounts of cash profit, even in the face of anomalous obstacles. The top quality brands are performing well and bringing new franchise locations that are close to rivaling the weaker brand locations' closures, and there are some potential mid to long-term tailwinds coming by way of the ERP system completion and the Famous Dave's franchise concept that is still in the works. Ultimately, when trying to decide what to do, we have to project what we think a reasonable future for the company will look like. With the upcoming minimum wage hikes in Canada, I think it's fair to assume that costs will rise in that geography, probably by somewhere in the ballpark of 5% over the coming year, which will impact margins and may lead to more store closures since the majority of franchise locations are in Canada and it's the franchisees that are taking on the brunt of these costs. How many stores will close? That's going to be hard to say, and it's going to depend a lot on other factors, including the economy and how willing customers are to go and eat out, which you might assume would be less, but this can be a bit of a misleading variable since a lot of MTY's restaurant banners are considered to be low-cost dining, which could actually see an increase in mild recession scenarios wherein people are still choosing to go and eat out, but they're choosing to do so at fast casual or quick service restaurants as opposed to choosing somewhere a bit more fancy or expensive. For the purpose of being conservative in our estimate, let's assume a scenario wherein the free cash flows decline by 3% for the remaining 3 quarters of fiscal 2024 and throughout 2025. Then, in 2026, we'll assume stagnation until the implementation of the new ERP system, which we'll assume is fully implemented about a year and a half late. From there until 2030, we'll assume a 3% growth rate to free cash flows thanks to the newly uncovered efficiencies via the ERP system. Now, this might seem like an overly bearish view of the future, but I'm trying to be very conservative since I want to be able to go into my investments knowing that even if the business is weak, I'll still receive a reasonable return. As of this moment, MTY is trading at about $47 per share, and letting the above scenario play out would give us a free cash flow collection of $37.66 over a 7-year period, versus $19.13 if we were to instead buy a treasury bond yielding 5% over the same time period. So even in what is far from an ideal scenario, the stock should provide reasonable returns relative to the discount rate, and that's without including uncertainties that have strong positive potential. If we instead create a scenario wherein the company simply grows in line with the rate of inflation and doesn't see free cash flows decline by 3% for the remainder of the year, then we could assume $41.45 in free cash flow over that 7-year period, which more than doubles the payout that would be received from a treasury note. So we've established that MTY is probably a good value compared to a virtually guaranteed investment. But what about its competitors in the same industry? Well, if we were to instead invest in a top industry competitor that trades more expensively because of a near 17% free cash flow compound annual growth rate, a similarly sized investment would take nearly 20 years of compounding at 17% in order to catch MTY's cumulative free cash flow in the bearish scenario, where MTY's CAGR tops out at 3%. So to answer the question of whether or not MTY looks like a good deal, to me the answer is a clear yes. Even if MTY's future is worse than the bearish scenario that I've projected, there's still a fair amount of downside protection baked in. And I think that there's adequate upside potential that really swings the balance of risk versus reward into the long-term investor's favor. This is why I've continued to buy shares in my Canadian cash account on TD, as well as in my Wealthsimple portfolio that I track every month here on the channel. On top of that, MTY also makes up my largest position within my TFSA at TD. Now, I mention this because I am a shareholder of MTY Food Group, so obviously I think it will do well. But these beliefs can be influenced by wants, and while I try to be as objective as possible in my analysis, it is possible that my ownership bias has found its way into my coverage or even influenced my judgment. On top of that, it is possible that I've gotten something wrong or missed a crucial piece of information that has the potential to drastically shift my opinion presented in this video. It cannot be stated enough that I am not a financial advisor, so it is of the utmost importance that you put in the time and effort to do your own research and come to your own conclusions using primary sources before making any investment decisions. This video is not financial advice. It was made for educational purposes and to highlight my own opinions. This video should only be relied upon for inspiration to do further research into the company outlined. After all, I'm just a Canadian who likes investing and sharing what I've learned with others. I hope that you found something of value in this video, and if you have, please consider sharing it with others. Thank you for watching all the way to the end, and enjoy the rest of your day.